Hey, everybody. Last week, the Fed did something very unusual. Well, I should say unusual since the financial crash back in 2008, 2009. If you remember back then, when the credit market seized up, there was an extreme situation of dollar illiquidity, and it really was focused mainly not just in the United States, but really outside the United States with institutions, foreign institutions, and some of those were financial institutions like banks, some of them were large corporate entities that had dollar liabilities, but dollar supply, dollar availability was just not available. And in order to preclude I guess what the Fed thought would be some sort of a major collapse, it engaged in these, what they call on their books, central bank liquidity swaps. These are actually Forex swaps where they enter into a swap agreement with foreign central banks, let's say the ECB or the Bank of Japan or the Bank of England, where the Fed provides dollars on a term basis in exchange for currency. It could be euro, could be yen. And these are basically short term dollar loans where the Fed holds foreign currency as collateral. And back then, I was talking about this on my blog at the time because this was the largest at the time when we were in the great financial crash. These central bank liquidity swaps were the largest single asset on the Fed's books at the time. They went up to something like almost 700 billion. There was not a peep heard out of Congress about these loans, yet everybody was up in arms about loans to General Motors, which to me, or loans to domestic banks, that's our system, that's our economy. I mean, that completely made sense to me. But here were these massive um, dollar loans, basically with open-ended risk, because what did the Fed get as collateral? They got foreign currency, which could depreciate. I mean, but there was nothing said about this at the time, but everybody was up in arms about what was the loan to General Motors, like 18 billion or 12 billion or something tiny. Meanwhile, 700 billion in these liquidity swaps. Anyway, I got off track here. So these things wound down pretty quickly, and I look at these every single week when the Fed releases its balance sheet report every Thursday. They've basically been down to zero for a long time. But last week they shot up to 12 billion, which put it at the highest level in 5 years. So there was something going on last week, probably related to some year-end liquidity issues where the Fed engaged in these forex swaps again to the tune of 12 billion in a single week. That put it up to the highest level in 5 years. And most likely it's a temporary situation. But you have to understand the ramifications of this. If the Fed doesn't do this, then basically you get a short squeeze in the dollar because these institutions that are short dollars and need to meet their dollar liabilities, they need to get dollars. So it would necessitate either the institution itself or its financial representative, its bank, or the central bank to go out into the Forex market and buy dollars, basically. So the Fed stops this from happening by providing these dollars on a short term basis under these swap arrangements. So we had that last week. Most likely these things will be unwound within a week or 2 weeks. Very easy to see. This is public information. It comes out every week, and I check this. And by the way, these are some of the things that I have in my MMT Trader report, which nobody else really follows, but my people get the most up-to-date and concise information. By the way, if you want to get a 30-day free trial of my report, go to pitbulleconomics.com and sign up for a 30-day free trial of MMT Trader. It is now $145 per month, which is still a bargain. In other news, everyone who has been with me, we have been long oil for a long time, even in the last couple of weeks. And I make these videos every Wednesday when the EIA report comes out. And I mock the zombies. Oh, how could I? Because, they're so easy. It's so easy to take their money. They look at one piece of data, let's say crude inventories, and they go plunging into the market based on that, where I have been telling you there is an enormous amount of information contained in these weekly reports, and you have to be able to understand it. You have to be able to synthesize all of that information into a concise outlook. What is going to happen? And I've been doing that, and my people have been long, crude up over 61 now. So that all comes with what I provide. So there you have it. We had the Fed liquidity swaps, the Forex swaps last week to the tune of $12 billion. Something happened right before the end of the year, probably some short-term liquidity issues. That tends to happen at year end, although this year it was pretty big. It was pretty acute, so we'll see what happens. All right, everybody. See you later. Bye-bye.